I'm Alan Inskip, founder and former CEO of Tempcover Limited. Tempcover, I guess, does exactly what it says on the tin. It is a insurance intermediary providing short-term van and car insurance for any situation where a potential customer needs flexible insurance from anywhere from an hour to 28 days. Tempcover came about from a night out in a pub. I was working for a previous insurance broker and had an evening out with one of our main insurers, the Royal Sun Alliance at the time. We began talking around industry problems, things that weren't serviced and catered for well by the existing players, and the idea of temporary insurance came up. There's still some debate between me and the other two people who were around the table whose idea it was, and I'm afraid everyone had had one too many drinks for there to be any certain outcome to that. But effectively the next day I then embarked on a process of registering the company in 2005 and then agreeing funding with my previous chairman and launching in, I think it was April 2006. We grew what felt like at light speed to begin with, albeit looking back now it was somewhat glacial. From memory, I'm sure we sold 4 policies, I think, in our first week, which was stratospheric at the time. From that comparatively modest start, we then built pretty quickly over the next probably 4 or 5 years to the point where we were getting to have an EBITDA of around about £1 million, there or thereabouts, and had built really strong relationships with our customer base and with our insurance panel and a number of national brokers that we were working with. We were a very stable business, everyone was making good money, there was healthy growth, if not super exciting growth, and the primary reason for that was the majority shareholder at the time was the chap I mentioned who invested in the company. We had got to the point where we were being run as somewhat of a lifestyle business for him. So I had several conversations with other members of the management team and then started going out to market in an effort to put together an MBO. The MBO process was long and tortuous. We spoke to maybe 15 different PE houses, maybe more than that actually, in terms of the initial letters. Eventually things were narrowed down to a field of 3 or so PE houses, of which Connection Capital were one. Connection Capital stood out from the rest of the field pretty much from the first meeting actually. Firstly, they were more personable than most of the other PE houses we met with. I mean, some of the PE houses we met with, I was really quite surprised when, obviously there's an element of us selling to them, but I also thought for most of them there'd be an element of them selling to us. For several of them that was the case. For others, they came in, told us all the things that we were doing wrong. There was no charm offensive. It was just a case of, you're going to take this money from us and therefore we'll tell you what we think, which didn't feel like a great foundation for a good relationship moving forward, and certainly wasn't the sort of thing that made me feel any sort of trust or warmth towards those individuals. And the flip of that completely was true of Connection. One of the things that we really liked was the nature of, we were told from day one that the person doing the deal with us, in that case, in this instance Miles, was also going to be the person who was sat on our board. So there was no immediate handover to someone else once the shiny salesman had done their work. And I guess the other big difference was that the model that Connection operates is very different to the majority of private equity houses out there. And that network of high net worth individuals that form the investor base was something that we were really keen to tap into and saw some really great potential for us. Across that network, it was very apparent that they had any number of individuals within that network who had really excellent experience, yes, in scaling businesses, but also specifically within the insurance world. And we were quickly introduced to 2 individuals, one being Peter Barrett, who went on to be our chairman, and another being Christian Young, who I had actually met years before, and they were both extremely influential in getting that deal across the line for us, and the relationships that were formed with them and the knowledge that they were bringing to the business, particularly in Peter's instance as chair, was absolutely invaluable. I think I would be downplaying the influence Peter had on the business if I was to say anything other than he was pretty instrumental in getting us to where we ended up exiting. Yeah, so the restructure of the team, I think, was the other sort of big change, and I think it was also fair to say it was one of the more difficult elements for me. The team that I'd had behind me that had helped me build the business up until that point, I had a lot of loyalty with them and been through quite a lot over quite a few years, including some close family members within that team as well. Combination, though, of connections, input, along with Peter's advice, allowed me to see over a period of time, and it did take some adjustment on my point, but allowed me to see that team, whilst being absolutely the right team to have got us to the place we weren't necessarily the right team to move us on to the next stage. So we, around about 18 months into the journey, embarked on a top-tier restructure. Several of those individuals who had been with us for a while were made redundant, which was a tough period, including my uncle, including a husband and wife team. So it was a really, really difficult few months, particularly for those individuals. But it was done so with absolutely the best intentions in terms of what the right thing was to do with the business. We then brought in a number of really high caliber individuals in the senior C-suite roles, and the difference that they have made over the period, but actually really quickly, within the sort of first 6 months of joining, was absolutely monumental. Very shortly after the deal was concluded, we lost our single biggest contract, which was with Confused.com, who we'll touch on again later. And around about the same time was the period when we were going through the restructure of the team that we've just touched on. And I think it's also fair to say I had lost a bit of focus myself. I had taken a fairly healthy sum of money off the table on the first deal and was busy building a house, in the midst of a divorce, etc., etc. So there was a lot going on outside of work. And it became evident that the combination of those factors was having a real impact on the business. We completed the deal on an EBITDA of, I believe, around £1.7 million. Within 2 years of that, we were on a run rate of circa 250k. So we had gone the wrong direction in a pretty major way. I think it's probably fair to say that the majority of other PE houses that I'm aware of certainly would have taken very different action to what Connection did. Connection doubled down. Connection, after some very hard work by myself and Peter and the rest of the management team to put in place an alternative plan to show how we were going to get to where we were going, and those funds gave us the ability to really step forward. Following that reinvestment, we utilised that money and that time to continue to supplement the management team, particularly with a second string below that C-suite, whilst rolling out any number of major changes to the business. Not least were changes to our entire front-end UX to be quite revolutionary, certainly within the insurance market, allowing customers to hit the website all the way through to transaction and actually receiving their policy documents within about 90 seconds, which for motor insurance is completely unheard of. That combined with any number of changes to our marketing, our CRM systems, our business information systems, meant that we were in a much more solid place to grow and grow at pace, which is exactly what we did. So we built on that 250 run rate to move to an EBITDA north of 6 million within, I think, around about a 3-year period. One of the other positives I didn't touch on with Connection, making them stand out from the rest of the PE crowd, is not being married to particular terms, 3-5 years attached to whatever fund. So they'd always made it very clear that they were relaxed about the exit point, and it needed to be the right point, yes, for the Connection Capital investment base, but also for the management team who had worked so hard to yield those returns. Pleased to say those offers came in thick and fast when we got to that point, and we were able to secure a really excellent deal with Confused.com. As I mentioned earlier, the culprit in moving away from us circa 5 years ago ended up being the business, along with RVU, their parent, that we sold out to. There are a wide and varied array of different PE houses out there, so I would say be very, very careful about the PE partner that you choose. Ensure that you reference them very heavily. Prioritise talking to the cases where things haven't gone right, not just those that have gone right. If the PE house in question isn't keen for you to talk to those that things haven't gone right, that's definitely a red flag. And then once you've chosen that PE house, I would say try and really embrace them. Any idea of keeping things separate and there being sort of a them and us culture is just going to result in failure. So I think embracing that relationship, leveraging the contacts and the networks they have in order to supplement your board, in order to bring on better quality management teams, it can't have anything but a positive outcome for the business. Yeah, it's all about making a very careful choice, but one that thankfully I think we got right.